What is up, everybody, and welcome to the JKAM Fund Overview. I am your host, William Bonati. The purpose of this video is to share the JKAM opportunity and why it's compelling for the passive investor. We welcome any feedback you may have, so let's go ahead and jump in. So here we have our disclaimer and disclosure. We'll be doing brief introductions, talk about the diversified fund, investor benefits, fund asset diversification, current fund holdings, the tax benefits, how to invest, and lastly, finish up with contact information for any questions or feedback that you may have. So let's go ahead and get started. For those of you who don't know me, I am William Bonati. I grew up in Colorado, got a degree in finance and real estate from Colorado State University. Right out of college, I obtained the Series 766 Life and Health and spent 7 years in the banking and investments field, and then transitioned into a more entrepreneurial path through investing in real estate. This started out with wholesaling houses, then flipping houses, then non-performing loans. And while living in New York City in 2014, I connected with Jack Krupey and then joined his team to run his non-performing loan dispositions trade desk. I was there for 2 years, and then both Jack and I left and have partnered up to form the JKAM Diversified Real Estate Fund. My family and I currently live in Vail Valley, which many of you may know of or visit from time to time. So if you're ever out this way, let me know. And Jack Krupey has been investing in both real estate and distressed debt since 2001. He has built long-term relationships with experienced real estate developers, sponsors, and syndicators over his 20-year career. Jack was extremely active during the 2008 financial crisis and made great returns, both acquiring and repositioning properties, as well as modifying and restructuring loans to create a win-win with the borrowers. In 2014, Jack entered into a partnership with a large private equity fund and led the asset management arm of that firm, which made over $3 billion in purchases of non-performing and reperforming mortgage debt between 2014 and 2019. So just taking a look at the timeline, our experience starting in 2001, Jack started buying real estate, again, focusing on single family and multifamily rentals. Then in 2008, he joined a New York City PE fund, which was buying distressed mortgages from banks. In 2010, he launched Gemini Capital Advisors, and in 2014, partnered up with a large private equity that I mentioned earlier. They ended up making over $3 billion in purchases of non-performing and reperforming mortgage debt between 2014 and 2019. And in 2019, Jack and I launched the JKAM Fund. So the Diversified Real Estate Fund gives passive investors the opportunity to achieve diversification, access to projects that are almost always off market, and participate in the tax advantages of real estate. And so the genesis of the JKAM Fund was born out of investing passively into real estate syndications. Jack couldn't personally invest into mortgage debt because of the conflicts of interest with the last fund. So he started investing in private multifamily real estate syndications and found it really time consuming to source and review possible deals. It was also really time consuming to build out a diversified portfolio of operators, projects, and geographies. This is because most minimum investments per project are $50,000. So it's no big deal if you have 1 million or more to invest, and hundreds of hours it takes to source, evaluate, do the paperwork for each project, and then manage all the K1s you get for each project. But if you're not that person, then you may only be able to invest in 1 or 2 projects. And 1 or 2 projects isn't exactly what I would consider diversification. Thus, the strategy of the JKAM Diversified Real Estate Fund was born. So let's talk about the realities or problems passive investors face when investing in real estate. The first is knowledge. You have to know how to evaluate real estate, if it's a good investment or even meets the objectives of your investment goals. You need to be really knowledgeable about what asset classes to select, whether it's single family rentals, multifamily rentals, commercial real estate, ground up construction, or value add. And then also what locations or geos, and then additionally which operators, et cetera, et cetera. It goes on and on. So this is a challenging proposition if you are trying to do this passively. The second is the time it actually takes. So don't be mistaken by what you see on HGTV and home flipping shows. Real estate investing is not easy, and it takes a lot of time to do it. And to do it effectively, you'll need to network and source opportunities, analyze and evaluate the opportunity, source the capital to fund the project, and then put the right team in place to execute on the strategy, and much more. And then after spending all that time working through the processes you need to have in place to be successful, you may only end up with one or two projects. And that leads to the third common problem, which is diversification. Most real estate investors get burned because they rely too heavily on one rental or one real estate syndication project. And when there's a bump in the road with a tenant or an operator, your return on investment can really be impacted because you only have one or two investments. So diversifying among larger, more stable asset classes like multifamily syndications is also challenging because of the higher minimum investment requirements. So most are $50,000, and this means you'd need to have a significant capital outlay to achieve diversification, not just among operators, but geographies and asset classes. The JKAM Fund provides the solution to those three major problems. Number one, with our experience and expertise, you can participate in quality, stable, and risk-averse projects that are hard to source if you're not in the industry. Number two, as an investor, you get a completely turnkey real estate investment. This means that you're not dealing with tenants and toilets, the time it takes to source and evaluate opportunities, completing the paperwork for each project, dealing with multiple or many different K1s during tax time, and lastly, the third, which is turnkey diversification. With a single investment into our fund, you'll be diversified across best-in-class operators, projects, geographies, real estate asset classes, which provides you with the advantages of real estate, which are higher returns, cash flow, and tax advantages. The JKAM Fund does all the due diligence you don't have time for, like the sponsor due diligence. We meet with the sponsor multiple times to establish or expand on long-term relationships. We evaluate their experience and track record. We review the terms they have in place, or not the terms, the teams that they have in place, including their construction and property management partners. These sponsors typically review hundreds of opportunities and bring us only a handful, which we take a closer look at before co-investing. And sponsors do a significant market survey on all their projects as part of their due diligence, which we also review. And then lastly is close communication with the sponsor. If we have questions or concerns, the sponsors we invest with are extremely responsive. The JKAM Fund has the partners and team in place for success. So we utilize strategic fund services as our fund administrator and accounting. The fund will be audited by DeJoy, Knopf, and Blood LLP, which is a member firm of the BDO Alliance. Syndication Pro is our investment platform, which provides our investors a portal for viewing fund updates, tax documents, current fund holdings, and then all the legal fund documents that you need to see. And lastly is Fisher Broyles, which is the law firm we utilize to form the structure of the fund and for any additional legal necessary. The fund is a Reg D 506C. As I mentioned earlier, one of the benefits to our fund is asset class diversification. And the overall fund asset allocation looks like this. 75% of the fund is in stable multifamily projects that are fully occupied and have positive cash flow. 20% is in higher returning projects like ground up development projects, specifically senior housing. And 5% is in higher returning transactions like non-performing loans, reperforming loans, and REOs, where Jack and I have significant experience from the last fund, where we managed a portfolio over 30,000 loans, totaling over $3 billion in value. Again, here are the asset classes the JKAM fund invests in: multifamily value add, housing development, and loan acquisition. Multifamily value add makes up the lion's share of the fund because of their stability in booms and busts, and with current cash flow and upside potential. So these are 100 plus unit buildings with on-site property management in strong and growing secondary markets. They are Class B, which is right in the middle and has strong demand whether the economy is in a recession or a boom. These Class B assets are typically 20 to 30 years old, and the value add strategy implemented is to renovate units as leases turn over and improve property amenities, creating the opportunity to increase rental rates and the value of the building. As we've seen recently with the pandemic, there has been a massive migration out of the cities and into these secondary markets where there was already a limited housing supply, further amplifying the demand for this type of housing. The JKAM fund invests in ground up housing developments like senior housing because of the higher cash on cash after 24 months and the high IRR upon exit. These are 100 plus unit independent and assisted living facilities which meet the need and demand for the aging population. These independent and assisted living facilities are constructed with designs to better mitigate the risk associated with the pandemic. So, for example, better heating and cooling infrastructure, wider hallways, et cetera, et cetera. So, in addition to being newer facilities, which already sets them apart from their competitors, they are also designed in a way that can best protect their residents through a pandemic. The loan acquisition is opportunistic and will only make up about 5% of the fund's capital allocation. Jack and I have significant experience managing over 30,000 loans at the last fund and can execute on mortgage debt acquisition, management, and disposition to achieve high returns. Thus far, the fund has made investments into 8 multifamily projects, 1 senior housing project, and 1 REO and loan pool totaling over 1,700 doors in 7 emerging markets and 7 states. Ultimately, the fund will likely make investments into as many as 15 to 20 multifamily projects and 3 to 5 senior housing projects. Here is a snapshot of the project locations thus far. So moving on to the depreciation and tax benefits. So one of the key benefits of real estate investing is the depreciation of the buildings, which passes through to the investors of our fund and can offset the returns that our investors earn. Our partners complete a cost segregation study, which allows for the depreciation benefit on the properties to be accelerated. The depreciation on the JKAM multifamily assets in year 1 has ranged between 50 and 90%. So for example, our Jacksonville project received a $462,000 depreciation benefit on a $500,000 investment. This allows you to offset other passive gains with this depreciation, and it does carry forward. So the JKAM fund expected net return is a 15% plus IRR, has a minimum investment of $50,000 and a preferred return target of 6 to 8%. There are 4 share classes that you can participate in. The 2 equity options are as follows. Share class B pays a 6% preferred, 70 to 70-30 split, 72 the investor, 32 the fund, and has a $50,000 minimum. Class E pays an 8% preferred, has a 70-30 split, and a $250,000 minimum. The fixed share class options are as follows. Class C pays a 10% preferred, has a 3-year term, and is a $50,000 minimum. And Class D is a 12% preferred and has a $250,000 minimum. So here we'll be outlining what a $100,000 investment looks like into the equity share class B. So you invest $100,000. In year 1, you receive a preferred of 6% or $6,000. The same in year 2, you receive a $6,000 preferred or 6%. And in year 3, as there are dispositions or exits from some of the projects, we'll start returning capital. And in this example, we return $50,000. So you'll receive your 6% plus $50,000 of your initial capital, totaling $56,000 in year 3. In year 4, you'll get a $3,000 in pref, which is 6% of your remaining unreturned capital of $50,000. And then we'll also return another $25,000 that year. So total cash for you that year is $28,000. In year 5, you'll receive $1,500 again, which is 6% on your unreturned capital of $25,000. We return $25,000 in principal, and you'll receive a total of $26,500 that year. In the 6th and 7th years, you'll get 70% of profits after all capital and prefs have been paid. Ultimately, this works out to 15% IRR, which we are trending well above based on the current projects in the fund. So if you'd like to see more detailed information on the fund offering, you can go to jkaminvestments.com/offerings and see more detailed information there. Thank you for joining us today. And if you have any questions, comments, or feedback, we'd welcome hearing from you. Have a fantastic day.